we exclude ProConnect out of the equation, our revenue growth, of course, would have continued to be at 1%, but our profit decline would have been 3% with an EBITDA growth of 4%. Now, when you break this down by geography, India for Q4 registered a revenue degrowth of 7% and a profit degrowth of 74%. But again, for a minute, with your permission, if I exclude ProConnect and look at our India distribution business, the revenue degrowth was 7%, whereas the profit growth, profit after tax, grew by an impressive 33%. Now, when you look at overseas grew top line by 5%, EBITDA by 8%, and the profit after tax by degrew by 14%. This is largely on account of the interest cost being higher during this period and the tax in Turkey, which contributed handsomely to the profits. Therefore, the tax component became larger. Whilst sharing this, I hasten to add that being the start of or the through the second half of March being the COVID period, we had an impact on India distribution by about 800 crores of sales which we lost. In Middle East, Turkey, Africa, we lost about $110 million of business. And in Singapore, South Asia, we lost about $27 million. These were confirmed orders, but we were unable to execute on account of lockdown. This totals to somewhere in the vicinity of about 1,800 crores, which would have, of course, pushed the top line, impressively, another 15%. And even the bottom line, from a distribution standpoint, would have been at least in the vicinity of additional 20 to 22 crores. But whilst talking about COVID, I already shared with you on our call on 30th April that we did come up with a Redington playbook, which we called it as the 7 C's, starting with making sure that our people are completely safe and protected. Thus far, there have been very few cases, positive cases, but we have managed to ensure that we continue to support them and their family, and we hope and pray that this number does not increase. On the other hand, the 7 C's basically relates to cash flow, which again, I wish to share with you with a higher level of confidence today than on 30th April, that we have managed to secure and have a very reasonably comfortable position with regard to our cash flow. And notwithstanding whether this COVID is going to play out to have a pessimistic or a negative impact or a severe impact, I think we are reasonably well prepared. We are focusing a lot on collections. We are making sure that we are frugal on costs. We have also want to share that
the conference is now being recorded.
A cut in the compensation with the clear objective that once we complete or pass over this COVID period, we should be able to, get the business, back to its old glory. From a customer point of view, we stay very closely connected with them and continue to be an important bridge between the vendor and the end customer. And very importantly, we have managed to ensure that we have not lost a single contract. On the contrary, we continue to reinforce our engagement with our vendors. we have ensured that we put in all controls so that if at any point in time we know that there is a problem on account of any issue, we have a contingency plan and a remedial plan in place. We also make sure that we communicate regularly to all our stakeholders, particularly our employees, to make sure that they follow all the hygiene conditions and practices. Sorry for the digression, just to come back. Therefore, I was talking about the overseas for Q4, which grew top line by 5%, EBITDA by 8%, but degrew profits by 14%, largely on account of increase in interest cost and the tax in Turkey. If for a minute we were to look at from a working capital perspective, for the quarter, I'm very pleased to share that the consolidated level, we brought down the working capital by 3 days. Here, overseas continue to maintain their working capital at 29 days, both for last year and this year. Whereas in India, there has been a significant reduction from 43 days last year in Q4 to 33 days in Q4 of FY20. The other very gratifying part is that the company delivered positive free cash flow both at India and at overseas level, delivering a positive free cash flow at a consolidated or global level of 1,267 crores. The return on capital employed, if taken at a net debt level, this works out to about 16.3%, largely coming out of overseas, which delivered a 20.3% ROCE. Similarly, with regard to our gross debt to equity, this was 0.54 at a consolidated level. Net debt to equity was just close to being zero at 0.03. In terms of the ProConnect, I must mention here this was a big setback for this year, particularly for Q4, where we delivered a revenue of about 95 crores, but degrew profits or made a loss of 37 crores. This is largely coming out of the trade advances that we had paid, if you remember, from our operations in East to Rapal, which unfortunately we had to take a provision because the partner did not pay us settle the trade advance. And in the meantime, since COVID had come into place, so that has become a very convenient excuse. So we did have to take a big provision there. We also had to take an impairment both at RCS level as well as at Aroma, which resulted in the profit after tax being minus 37 crores. If for a minute I switch gears and go to the full year FY20, the revenue growth was 11%. And what is very gratifying is that we breached a revenue of 51,514 crores. We had this fond desire of, breaching this 50,000 crore mark, which I'm happy that we could deliver in a rather difficult year. And in terms of the EBITDA, we grew by 10%, and the profit after tax growth was just 1%. This is essentially on account of ProConnect. Therefore, if we exclude ProConnect, the profit after tax growth would be 20%. As far as India is concerned, which includes distribution and ProConnect, the revenue growth was 10% and the profit degrowth was 16%. But if for a moment you exclude ProConnect from India and only look at the India distribution business, our top line grew by 10%, EBITDA by 17%, and profit after tax by 45%. However, ProConnect, on the other hand, did deliver a turnover of 432 crores, thereby growing at 7% year on year, but made a loss for the full year at 57 crores. Again, a big part of this is a provision towards the trade advance which was given. Also, there were impairments, and we also had some of the contracts on which our margins came under pressure. If we for a minute shift to overseas, for the full year, the revenue grew by 11%, EBITDA by 17%, and profit after tax by 10%. Now, here again, I must mention Turkey. They had a very good year and grew on all the revenue, EBITDA, and profit after tax for the full year. If you, for a minute, look at it by business vertical, as in IT, mobility, and services, I'm pleased to share all three businesses grew. IT at 2%, mobility was very strong at 26%, and services grew by 9% at the consolidated level. At an overseas level, again, IT, mobility, and services registered a growth of 7%, 18%, and 6% respectively. In India, the one low light being that IT registered a degrowth of 5%, but this was more than made up by mobility, which grew by an impressive 51%, and services grew by 11%. If for a minute again we look at the working capital, at the consolidated level, we brought down the working capital from 37 days for FY19 to 31 days in FY20. Overseas continued to be steady. However, they brought it down by 1 day from 31 days to 30. India had an impressive working capital reduction from 48 days in FY19 to 31 days in FY20. This certainly was one of the big reasons why we also delivered free cash flow, positive free cash flow for the full year FY20 at a consolidated level at 967 crores. This was contributed significantly by India at 792 crores and by overseas at 175 crores. Again, if you look at the return on capital employed, at a consolidated level, it was 18.1%. I hasten to add here that we have taken the net debt basis, and overseas was a significant contributor at 19.8% ROCE, with India at 15.8%. On return on equity, at a consolidated level, we delivered 12.6%, which was 12.8% in the case of overseas and 12.1% in the case of India. At a gross debt to equity and at net debt to equity, it was 0.54 and 0.03 respectively. In terms of provision, at a full year level, the inventory provision was just 2 bps in the case of India, 8 bps in the case of overseas. Thereby, the inventory provision was about 6 bps. In the case of provision towards bad and doubtful debts, at a consolidated level, it was 0.1%, with overseas at 2 bps and India at 22 bits. I certainly share with a heavy heart and a tinge of sadness that ProConnect for the full year registered a growth of 7%, turning over 432 crores, but made a loss of close to 57 crores, and largely again coming out of the trade advance, which I already mentioned. So for us, the biggest learning from all of this, and I must confess, if the one thing that all of you would certainly have in your mind is that for this company, ProConnect, which had an impressive past where we grew the top line and bottom line by 6 times in 6 years, 2013 to 2019, we grew revenue from 65 crores to 404 crores in FY19, from 4.4 crores in FY14 to 29.5 crores in FY19. So we had an impressive track record, but I must confess that we, in spite of making a significant investment in the acquisition of the asset in East, we still, the company was largely managed by the erstwhile, the owner of the company, and we should have taken all necessary steps towards changing the management and putting in all our systems, processes, and controls. Since in the first couple of years it was working well, and since the arrangement with the partner was such that they would provide all the transportation services for the entire operations in East, and therefore we did not have to invest in anything to do with, and we thought that was a good arrangement to keep the business asset light. But in the absence of not having our own management on the ground and not putting in effective controls, giving trade advances which were not properly scrutinized, I certainly, stand guilty in front of all of you as that we could have managed it better. The only thing that I want to tell you now is we certainly have put a complete rethink and have got a new plan in place. We are very confident that in the way forward, we should be able to get ProConnect. This year will be a year of correction and consolidation. We will definitely, a big part of the issue is already behind us. We have taken the necessary hit for the year gone by. We are bringing in a lot of changes in terms of organization structure, business structure, and putting in much better controls and making sure that we focus more on profits than on scaling the revenue. With this, I will now want to hand it over to all of you for your questions. Before I do that, I just want to share with you that I have on this call my colleague who's the CFO for our overseas operations, Sriram Ganeshan. Sriram is a chartered accountant and has been working with Redington for 20 years. I would say he has been very instrumental in helping the company through this whole evolution from being a small company in the second year of operation at $35 million to now last year in FY20, we breached the $4 billion mark, setting up the complete operations, taking care of the center of excellence in India, taking complete ownership and accountability. An amazing individual, extremely knowledgeable, very analytical, very mature. We took your feedback that, it would be good to have somebody from overseas, which has been a significant contributor to the top and bottom line of the company for the last several years, if not a full decade, we thought it may be a good idea to have him on this call. So if there are any questions relating to META, which is Middle East, Turkey, Africa, Sriram would be delighted to answer that. Sriram, would you just want to introduce yourself before I hand it over for questions from the investors?
Sure, sir. Thank you for the kind words. Hello, everyone. Wish you a very good evening, and I hope all of you are keeping safe. As Mr. Raj said, I've been with Great Nutrition for the last 20 years, and I'm responsible for finance and the Center of Excellence operations for Redington Guys. So happy to address any questions that you may have.
Thank you, Sriram. Back to you. Yeah.
We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Hi, good evening, everyone. Hope you are all safe and well. I just had 2 questions. One is on if you could give some color on the 3 businesses within logistics, which is ProConnect, Aroma, and Rajkotan. What are the changes that you're looking at strategically within those businesses? I'm sure ProConnect on its own is doing pretty well. If you could give some color on each of those and whether you think there is a need for a capex-heavy model for the transportation business and your thoughts there.
Thank you, Nitin, for your question. Krishnan, I will take your help subsequently. Let me just give a perspective, and then if Nitin has a follow-on question you may want to add. So first is, Nitin, when you look at the 3 businesses, just to give you a sense, the RCS did approximately about 73 crores and change as far as FY20 is concerned. And but however, delivered a loss a little shy of 50 crores. Now, when you look at Aroma, we did about 82 crores and delivered a profit of about 3.4 crores. Krishnan, wherever you feel the numbers need to be sharper, you may chip in. And the balance, as you can imagine, comes out of ProConnect. Our biggest challenge has been that since a good part of the capital was invested in funding RCS and Aroma, etc., so there was a huge burden on ProConnect in terms of interest cost and what have you. So the question is, in terms of the way forward, what do we plan and what's exactly our strategy? The first thing that we would want to do is completely reassess our RCS operations, where we have brought in a completely new team. It's already in place, and there are now all the contracts are now being vetted and validated. And we believe that in the next 1 quarter, notwithstanding COVID, we should be able to at least put this RCS business at least at being efficient and at least starting to break even. However, we are also evaluating the opportunity if there are any other possibilities of unlocking value, but I will for a moment leave that as just as a point for you to note, though I may not be in a position to dwell into detail. On the other hand, as far as Aroma is concerned, while the company is doing reasonably well and profitable, what we intend to do is to merge it, during the course of the year and make it as a part of ProConnect so that we have one ProConnect, no more of having RCS and Aroma, etc., so that it becomes very clearly one company having operations on a pan-India basis. The primacy to warehouse management and mission critical services is what is going to be the focal point. Transportation businesses will only be a part of the total logistics solution, but transportation as a business, since it tends to be yielding very low margin and profits, we have therefore decided to completely downsize that part of the business. There was an endeavor towards doing the transportation business in the past purely because it helped us to scale the top line, but it's certainly a drag as far as the bottom line is concerned. But fundamentally, we want to make sure that ProConnect continues to deliver best-in-class service to Redington, which is something which continues to be an important anchor customer. So in summary, in the way forward, it is going to be focus on profits and not on top line. Focus on making sure business hygiene is taken care of. Focus on ensuring that we bring about one ProConnect, whether it means merging Aroma or if RCS we cannot find any other solution that we think is attractive or compelling, then would also be a part of one ProConnect. Focus a lot on warehouse management and mission critical services, which is core to what we know, what we understand, and where we believe the value proposition is. If that explains, Nitin, I'm sorry I took a little more time. I hope that gives you a reasonable color.
Yes, it does. That's very helpful, actually. So, do you think by the end of the year we should be in a position to really get back to the normal mode of business and growth for this entity?
So that is exactly the plan, Nitin. We believe this is a business which is core to Redington. We have got it wrong. We have learned. We know what went wrong. We have now started to put all the fixes in place. So therefore, to your question, we are confident that we will be able to correct it. We will be able to consolidate it and once again put this company back on the growth mode by the end of the year.
Sure, that's very helpful. Just one last one from my side. Is there anything that you're planning in the near to medium term with regard to Turkey? I ask this because the stock is up 58%.
I honestly, Nitin, I have still no idea what ignited the stock price. I honestly don't have an idea. But all that I can say is the company is doing very well, contrary to what most people think, and they may still feel that Turkey, they may have some bad memories of the currency going through a serious depreciation. But I want to tell you that FY20, they have delivered remarkable numbers. Every single quarter they grew top and bottom line. We have generated positive free cash flow. In the marketplace today, I probably being a little audacious to say that we are probably the leading player from an IT distribution standpoint. So we are extremely well placed. So we therefore want to continue to put our nose to the ground and continue to drive this business because we are extremely well placed.
So thank you so much and all the best.
Thank you, Nitin.
Thank you. This question is from the line of Aditya Babar from Axis Capital. Please go ahead.
Hi. Thank you. Good evening, Mr. Shankar, Mr. Krishnan, Mr. Sriram. I genuinely hope that everyone at your end, including the Redington family, are all doing well. So 3 questions from my end. Firstly, just wanted to get your understanding, post the COVID situation. Is there a change in terms of the narrative by some of our key clients, HP, Dell, Apple? Are they looking to modify what their earlier targets were? And if so, what is the quantum of the decline that we are looking at? That's question number 1. Question number 2 is, can you dwell a little more in terms of reduction in terms of our working capital? Just want to understand what was, the reduction. Is it more structural? So if you could help us understand what was the working capital, let's say on 15th of March or on 31st of May, that would be sort of helpful.
Excellent. So that would have meant 2 questions, or the second one has a part A and part B to it, right?
Yes, sir.
Okay. I'll take the working capital question first. So you would probably have seen, as far as the working capital for overseas is concerned, it has been quite stable and steady over the last 4 years or over the last 20 quarters. And it is somewhere in the vicinity of about, let's say, 29 to 33 days. So I think over a period of time, we have managed to keep the working capital under check and control, and it has worked out well as far as overseas is concerned. Now, as far as India is concerned, this was something where we wanted to make sure that we put all the fixes in place. So to answer your question, even though when you look at, the year over year, we had for the full year 48 days of FY19 coming down to 31 days. But if you look at the individual components, the debtor days, which used to be 67, came down to 57. The inventory days, which used to be 36, has come down to 23. And of course, the creditor days, because we didn't buy as much during the second half, also came down by 6 days from 55 to 49. So the first point I'm trying to impress upon you is this reduction is an all-rounded improvement, whether it is in terms of debtor days, inventory days, or for that matter, the creditor days.
That's quite impressive.
Say that again?
No, I just said that's quite impressive.
Yeah, thank you. So I also want to mention here that the mobility business that we did, which was an absolutely wonderful performance, any which way one looks at it, certainly was a big contributor to the capital efficiency. So we therefore want to continue to drive and scale that business, because there is a huge merit in continuing to pursue the mobility business, because it is working capital efficient, and it is ROCE interesting. So that is what is going to continue to be an important factor to make sure that this is just not a flash in the pan. Now, that 31 days may be a very aggressive number, but I would believe that something like about 5 to probably 5.5 weeks is where we want to really focus and make sure that we peg it at that level or less at all times. Mr. Rao, I forgot your first question, and I'm sorry.
Yeah, I understand, sir, and that is quite impressive. So what you're saying is that on a structural basis, our working capital at the India business has come down from 49, 50 odd days to about 40 days.
Absolutely, or less. Correct.
Perfect. Understood, sir. My second question was trying to understand whether there was a change in narrative by
Oh, yes.
And if so, the magnitude of the change.
Before I answer that question in a pointed fashion, I must tell you that it has never happened for us in India that our accounts receivable is equal to accounts payable. So the first thing I want to say is with regard to the vendors that they have been supportive, and we've also, negotiated hard with them, and at the same time ensuring that we stand by them to make sure that their objectives are met. So the first thing is there is a very nice, equitable relationship, and it has worked well on both sides. Now, with regard to the narrative, this current quarter, they fully understand that the business would tend to be a little soft. But again, I don't want to spill the beans. Our own internal view, which was a little, we had looked at three scenarios, which is moderate impact, sort of a significant impact, and severe impact. We planned everything basis significant impact. It appears that we are going to be now somewhere landing between moderate and significant if the current trend is anything to go by for the current quarter or the current half year. This is how it appears. So for the next quarter, as far as the vendors are concerned, they believe that while the business will not bounce back to normal, that they believe that the pickup should start and, things should start to progressively get better. So Q2 will be definitely better than Q1. And they all expect that the real bounce back and the business being normal would more happen in Q3 and beyond.
Understood, sir. Understood. That's quite candid, sir.
Thank you.
Sir, just one last question.
Mr. Aditya?
Yeah. Okay. I'll come back to you.
Sure.
Thank you.
A reminder to the participants, please limit your questions to two per participant. Should you have any follow-up, request you to rejoin the queue, please. The next question is from the line of Pawan Aluwalia from Lebanon Capital. Please go ahead.
Thanks very much. Just two questions. One is on the competitive environment. So obviously this has been an industry where Redington and Ingram have been the leaders. And then there are maybe 3 or 4 mid-sized players in the market and then a long tail of smaller-sized players. Any early signs on how this might evolve? Are either the mid-sized players or the smaller distributors starting to potentially throw in the towel or be less active or anything like that? And second, in terms of credit risk, as you look at the portfolio right now, are you worried about potential credit issues on the receivable side? For example, with say smaller shops, that may not be able to sustain closure for a month or two, as we've seen in the lockdown. Any sort of analysis you've done in terms of what we can expect there?
Krishnan, would you want to take the question on credit?
Sure.
Credit risk? Yeah, thank you.
Yeah. So as Mr. Raj explained, one of the 7 C's that we have been pursuing very focusedly is the collections. And I can say during this period of lockdown, if at all, we are only positively surprised with the collections that had happened within our expectations. So as we speak now, we haven't had any known case of any issues as far as the ARs are concerned. So the collections have been good. And we also want to focus on the partners who have good customer bouquet, who have been having good credit history and sound financials in terms of focus on, and then also structure certain financial solutions by this thing tying up with financial institutions, wherein the partners can be provided more funds to handle the current COVID situation. So broadly, we are comfortable and we don't foresee any challenge in this.
So, Pawan, if you're satisfied with that response, I just want to add one more thing.
Just one follow-up. So that was for India. I'm curious about internationally as well. As you look at the portfolio today, are there any areas where you, as the CEO, are concerned that we may have credit issues, or you feel pretty satisfied that despite this big disruption, we're not likely to see credit quality issues in significant measure across the portfolio?
So I will certainly give you that feedback, and I also want Sriram to comment about overseas. Here is my comment, Pawan. Absolutely, truth be told, I was nervous. I may not have given that impression. I was worried. All that I can tell you now, looking at the way the collections have happened through April, through May, and until today, we are far better placed. Things are just very quickly coming back to normal. So we at the moment are not seeing any signs of worry or concern. I don't want to give the impression that everything is hunky-dory, but all that I can tell you is this was worrisome about a couple of months ago, but looking at the way that our team has managed to do the collections, it is extremely satisfying. So that's one point. The other point I wanted to mention about overseas in particular, which may not be true for India, a good part of our sales comes out of online and offline stores, where by and large payments are not, are not a real risk. But having said that, I would like Sriram to comment.
In terms of the Middle East, West Africa, while in the initial phase of lockdown, there were some delays in terms of collection coming in from customers for obvious reasons. I think subsequently, since late May, collections are absolutely on track. As Mr. Raj said, we were quite pleasantly surprised that the collections are flowing in very well. No concerns at the moment on collectability or delinquency from a customer standpoint. One other point which may be of interest is, since some of our receivables are also insured, our credit insurers are continuing to maintain the credit limits that are offered for customers for Redington's business, also placing comfort on our strong credit management policies. So to summarize, at the moment, collections are largely on track, and there are no concerns for the collectability perspective.
Sriram, one question that Pawan asked in the last call, which you may want to clarify, what percentage of the business that we do in the Middle East is credit insured?
So from Middle East standpoint, if you look at markets, UAE and KSA, which are our largest markets, about 93 to 94% of our receivables would be insured.
Thank you, Sriram. Pawan, does that give you a perspective on credit and collections?
Yes, thank you very much.
Okay, excellent. To your first question, at the moment, it's still early days, Pawan. We have no good, feedback or a clue in terms of some of these, as you said, the mid and the small distributors probably, finding themselves in the cash flow pressure, etc., etc. At the moment, it is still early days because effectively business started on the 11th of May, and even there you would know, there are still a lot of red zones, etc., etc. So probably, a quarter from now, we would be in a better position to, to give you a better feedback. But my guess is that things will change. So there would be a scope for consolidation.
Got it. Thank you very much.
Thank you.
Thank you. The next question is from the line of Jayesh Gandhi from Aditya Birla Sun Life. Please go ahead.
Good evening, gentlemen. Thank you for the opportunity. One real commendable job has been on the net cash flow from operations, which has been really very strong this year. And I'm really glad to hear the management commentary about collections coming in, which is good. But what is surprising to me is our outflow on finance costs has really not gone down this year. For the next few years, obviously the business will get impacted in the first quarter, but hopefully comes back in the quarter two and quarter three and thereon. How do we see the overall finance cost for the next few years? Will it go down, or do you see it remaining at this level?
Great question. Krishnan, you want to take a stab at that?
Sure. So first, as part of our exercise to bring in efficiency, the capital allocation has been an important component of our position now. So we would want to rationalize capital and channelize that to the businesses where it is higher ROCE carrying and more strategic in nature. So we think we will be able to rationalize the working capital and not let the current better working capital situation to let it slip. And with this, we think our working capital utilization and debt levels will be in control. There could be some small increase in the interest rate because of the current situation. So the interest rate can go up. And also interest cost, while on one hand because of working capital efficiency can come down, this is a situation where we should also keep higher cash balance, positive cash balance. This is what we would normally want to keep. So that should also can possibly add on to some interest cost. So just to sum it up, I don't expect worsening of this, but there may not be some substantial reduction in the interest cost, and that's very conscious. Just wanted to be safe, and this is something that can happen as we move forward in the future years.
Sorry to reiterate this point, but our total interest outgo for the whole year, both on the consolidated basis, is nearly 200 crores, whereas our net debt levels are significantly lower. In fact, the interest cost outgo is higher than the net debt level as of March. So I'm just wondering, is there something better that we can do?
No, it's a very fair question, Krishnan. Let me try and articulate. So to answer your question, should we see the finance cost as a trend, notwithstanding this quarter, next quarter because of COVID? Therefore, we are taking certain contingency measures. So I'm keeping that aside. On a steady state, should we look at finance cost coming down? The answer is yes, you should see that. The reason is our working capital is coming down, and I would like to believe that our interest rates will also come down. So all things considered, we should look at a reduction in finance cost. The question is how much, but conceptually this is the way you should look at it. Krishnan, would that be fair?
Should be fine, yes.
Yeah. So since you're at this point, is it you look at it as a percentage of sales or as an overall cost in the business? How does the management?
Wow, fantastic, sir. Really appreciate. So for us, we used to look at it as a cost. Now it is an important item which is factored as a percentage of sales, and therefore when we do the pricing, we take this into consideration while doing the pricing. So if there are transactions where the credit period is longer than the credit period given to the customer is longer than the credit period that we enjoy from the suppliers, then we want to make sure that we factor for that cost of capital while doing the pricing. So the whole approach now has changed. So if that would answer your question, it will be going forward more as a percentage of sales.
Wonderful. Good to know that. The other question I had very quickly is on the international operations. Turkey, I always thought that we had an opportunity to reduce the capital employed there by getting some money back either in form of dividend or buy back our shares, etc. I don't know what happened to that plan. I know Turkey is doing well, but I guess a lower capital employed international would really help, right?
It's a fair point, but since you have raised that, I'm a little keen to share something with you, and I hope I have the time and I'm not eating into somebody else's questions. Overseas, I just want to tell you for FY20, the cost of debt capital was 5.4%. The return on capital employed was 19.9%. Of course, I must mention that we have taken net debt into consideration. This is therefore a value creation call, if you will, of around 14+%. So the first point, there is oftentimes a mistaken notion that overseas does not give the right kind of return on capital employed as India, because the way to look at it is India, the cost of capital and the borrowing is in Indian rupees. Therefore, returns are to be measured in relation to that. Overseas, the borrowing is in US dollars and the currency and the equity is in US dollars. Therefore, when you look at return on capital employed, this is for last year. And if for a moment you tell me, hey, give me 1 year, the previous year, cost of debt capital was 5.5% overseas, whereas return on capital employed was 18.2%. which you will agree is approximately about 13%. So, net and sum, the overseas at the moment in the last few years is giving an interesting return on capital employed. So, that does not take away the fact that can we deploy capital even more efficiently to maximize return. I am with you. But I just thought it may be helpful to probably understand this perspective.
No, thanks for it. I thought we had a plan to reduce it. That's why I thought
No, you are absolutely right. But I thought Nitin asked a question that since then the stock price has run up and a few other things, the currency had depreciated. So it's looking a little different than what it was earlier. So at the moment, allow me to only say so much. But we will in due course of time. We are evaluating all options. Let me continue to say there is nothing off the table except that it is not looking as attractive as it once was.
Wonderful. All the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Dharmesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and thanks for taking my question. So, related to this COVID crisis, one thing which a previous participant was alluding to was that there might be consolidation in favor of larger player in the industry, but then there might be a consolidation in terms of your customer base as well. So that is one trend. And second trend being because of lower incomes, there might be a downtrading in terms of the brands that people use. And Apple is one of your major, which is much more pricey brand compared to many others that you have. Which so considering these two trends, how do you see the interplay of these two trends on your business for this year and going forward? And second question is on the working capital days reduction in India business, which has come down quite sharply. Is this sustainable? Because this frankly, increases the return on capital employed by almost a factor of 20-25%. So is this sustainable and what cost? And if it is sustainable, then what are the reasons behind the sharp decrease?
So on the last question with regard to working capital, I did mention that while it has certainly come down, you're right, to 31 days for last year, what one should look at is somewhere in the vicinity of about 5.5 weeks, which is somewhere around 37-40 days. This, in our opinion, for India, would be a good, a good target to assume, because this will be approximately about 9 to 10 working capital turns, and to that extent, it makes the ROCE that much more interesting. And this is clearly what we are focused on. Now, to your previous question, is there a likelihood?
Is that a sustainable working capital level, which is much lower than the previous?
Like I said, 31 is something that is honestly too good to be true. So, which is why I want to, just sort of set the expectations right, that if we are able to do around 37, 40 days, which is doable, and which is what now as a company we are extremely focused on. So is that doable? That's exactly what our focus is and what our aim is. So we are allocating capital, as they say, make the suit according to the cloth available. So we are saying this is the capital and let's try to maximize return. Now, to your earlier question about the consolidation, can it happen at the partner level? Yes, you are right. Logically speaking, and I would also assume there will be some level of consolidation happens. But it is finally, who's the last man standing, and we believe that we are extremely well placed. We have a very clear opportunity for us. So we believe when there is a distributor consolidation, if it happens, there would also be a partner consolidation that could happen. I cannot argue against it, but that should not take away the opportunity for those who will continue to play the game. So I believe that in the way that we have positioned ourselves as a very strong distributor playing both the consumer and the enterprise space, both on IT and mobility, we should be able to continue to, drive this business profitably. You had one more question. My apologies, I don't remember.
The down trading in the brand mix.
Yeah. Now, honestly, it may be difficult for me to give you too much of input. Suffice it to say that contrary to what you said, the business that is really showing a lot of traction, lot of momentum, once again for this year, at least in the last 1 month since the commerce is possible, it is the mobility business. While the enterprise and the IT consumer is also catching up, the one that's leading the game for us is the mobility. And I have absolutely every reason to believe that this will be another good, solid year for Redington in the mobility space, without a doubt. I'm sorry I'm sounding extremely overconfident, but I feel very bullish going by what we have been able to deliver for the last 5 quarters and continuing into this year.
Understood, sir. Your margins are lower for less expensive brands and vice versa. Is that true, sir?
The margin, when you look at it as a percentage, will be higher. But when you look at it in absolute value, what you make out of one device of a mid to high-end phone and what you make of a mid to low-end phone, you would agree with me that there would be a stark difference.
Understood. So you don't see this downtrading, sir?
It may happen. it will be very inappropriate of me to say no, it will not happen. Yeah, it could happen, but that is for a certain point in time. But I think soon the dust will settle down, and then you will see that the way some of these companies are positioning themselves now is very different than the way they positioned themselves in the past. So you would see that, some of the recent launches done by some of the global brands, they're extremely attractively priced, and they have very good functionality and features, makes it a very compelling and an attractive proposition for consumers. And trust me, I'm probably repeating myself. If the last 1 month is anything to go by, I think, it's certainly giving me even more a stronger conviction that this will play out. This down trading may happen for some time. I cannot disagree, but it will eventually, normalize itself. Thank you.
Thank you, sir.
Thank you. A reminder to the participants, due to time constraint, please limit your questions to one per participant. The next question is from the line of Pranav Kshatriya from Edelweiss Securities. Please go ahead.
Hi, thanks for the opportunity. My question is with regards to this COVID-19-led disruption. In the call which was hosted in April 30th, you had expected around 15 to 20% kind of a decline can happen in Q1 and then subsequently recovery taking us back to the normal level in 2 quarters. Given the lockdown has extended and the number of cases are also increasing, do you see risk to this number? Any update on that would be helpful. Thank you.
Soumya, I would request you to step in because I don't recall mentioning 15. I don't know if he mentioned as 50 or 15. Sir, what did you mention it as? 15 or 50?
15.
Unlikely. Soumya, could you please check the record?
I might have, my interpretation could have been wrong. Whatever.
Oh, okay. No. Then I wish to clarify. Soumya, if you have the number, you can clarify. Otherwise, I'll continue.
Sure, sir. So I had spoken in the April 30th call. You had made a mention that there is probably a likelihood of that kind of a decline rate to happen for the H1.
Okay. So here is what I would tell you. Given that April and May and now we are in June, our initial projections was that we would, for this month or for this quarter, we would probably degrow, let's say about 40% or so. But I can tell you as we speak, that number will be lesser than, the degrowth will be lesser than that. And if that is on one side, and on the other, as we look at Q2, we are expecting Q2 to be better than Q1. So this should improve as we go into Q2. Like I said earlier, I expect really things to get back to normal starting Q3. And of course, Q4 will be, absolutely back to our heydays.
Okay, so that's it from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Asim Berde from IDFC Securities Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just one question. Can you talk about the IT business outlook for FY21? In FY20, it was negative, and in this quarter, at least, there has been a lot of noise about IT enablement for work from home and all. So what would be the outlook for this segment this year?
Okay. For India. So because I wanted to first clarify that IT grew for us last year at a consolidated level, albeit by just 2%. Overseas grew by 7% and India degrew by 5%. Since your question is specific to India, how do we look at it given all this work from home opportunity? Very clearly, we see that as a positive opportunity. There are times when we want sometimes supply and availability can be a constraint. At this point in time, certainly there is demand and probably pent-up demand to be served. So the next, some months and some quarter is certainly going to be, interesting. So we do see this as a positive opportunity.
There should be growth, right, this year?
There should be. No, okay. Now, the word growth has a bit of a catch to it because if the whole of April, was a lockdown And if May, we could technically start business on the 11th of May, and 18th is when some more places started to open up. So how much ever we try and do, the word growth, when it is not on a like-for-like comparison, may not be a right way to look at it. But if your question is, how well poised is Redington to capture this newfound opportunity on account of work from home towards various mobile devices, whether it's tablets, whether it's iPads, whether it's PCs, whether it's laptops, and the mobile printers and what have you? The answer is absolutely well poised, and this is something that we are certainly driving and pushing for.
Okay, sure. So just one final question. In Rajkottan, all the advances have been provided for, right?
Absolutely. Sorry, Krishnan, would you want to take that question, please?
Yes, it is completely done.
Okay, sure. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Rishabh Chudgar from Inam Holdings. Please go ahead.
Yeah, hi sir. I hope you and the team are safe. And thanks for giving this opportunity. I actually just had one quick question. Will it be possible to share what will be the capital, what will be the ROC which is in the mobility business now? Because I'm seeing that incrementally your ROC levels are increasing, and a lot of your revenue figure in the mobility business across India and overseas is higher. So has there been a change in the ROC levels in this segment?
So the question is specific to ROCE for mobility business in India and overseas. Is that the question?
Yes. Compared to what it would be 2 years back.
Okay. Krishnan, do you want to take that?
Okay. So it will be better. Our threshold ROCE level is about 16%. That's something that we keep it as a fundamental ROCE. Definitely, what we earn from the mobility business is much better than the 16%. I'm not specifying the percentage here, but it is definitely much better than the rest of the business.
Okay. Okay, thanks. My other questions have been answered before. Thank you so much.
Thank you.
Thank you. Take the next question from the line of Ridesh Gandhi from Discovery Capital. Please go ahead.
Hi, sir, and congratulations on a performance given the COVID situation, especially on the distribution side. Just had a question on, given the pressure of potential OEMs would also have on their own profitability, and do you think there is a risk that that brands like Apple might move to a kind of direct distribution with the online players like an Amazon or Flipkart, which could in turn impact us? Given in other global markets, they do go directly to Amazon.
Okay. So do I see, first of all, your first question, are these vendors now going to come under pressure, and therefore is there a likelihood that they can probably skip and go directly to online players? If that is the question, the answer is very unlikely. One can never rule out, who can do what, but I'll tell you very unlikely, and this is something over the last 5 years we have demonstrated this. That this concern was there 5 years ago when some of the online players were really shaking the market, and therefore there was this tendency and worry and concern whether the vendors will go direct and thereby completely disintermediate the distributors. If this 5 years is anything to go by, trust me, we have hardly lost any business on account of this business model or a change in the business model. The vendors need us because if they want reach, coverage, and they want to make sure their products are available at arm's length of demand. They need a player like Redington, who's got a pan-India presence, who's got the ability to take products and deliver that at arm's length of demand. Now, with regard to online players, even they don't want to carry inventory. They want to be working capital light. So to that extent, they also want to make sure if there is a distributor who is able to give them credit and they are able to sell on cash. Because if you deal directly with the vendors have their own set of conditions. You need to give a standby letter of credit, and these are the terms and conditions. There is a minimum order quantity and so on and so forth, which a distributor would be able to do because they are able to amortize their cost on a pan-India basis, which any one company will be finding it difficult. More so when they dabble in so many million products. So it would just not make sense to be able to go to them and do this. So both the online companies and the vendor, both of them there is an absolutely clear role of a distributor, without a doubt. Trust me, there is absolutely no way that a distributor can get disintermediated. Whether the business from online can go to offline and vice versa, that may be possible, but we believe that our business is pretty solid and has a long shelf life.
Good. And our profit margins, which we make for online versus offline, is identical. So if we sell an iPhone, whether it's through a local store or through online.
Okay. The word identical may not be the right term I would use, but for if one were to look at the quantity, if one were to look at buying big quantities, secure payment terms, and so on and so forth, the margin that we make, if one were to look at risk-adjusted margin, and for the capital that we invest in that particular transaction, I would say yes, it would be to a large extent similar.
Got it. And just a last question, in actually other more developed e-commerce, markets like America, etc. Do Apple and all go directly to Amazon, or are they still using like global American distributors just because of the importance and the role they play?
See, there are two ways of looking at it. One, a lot of these online players, they have what they call as a direct and indirect model. The indirect is the marketplace. So to the extent it is marketplace, obviously, there's no question of going direct. So in fact, more and more of our partners who buy from us are really going to the online marketplace and selling their products. Yes. So, and whereas, yes, there is a certain amount of direct business to that extent, like I said earlier, the online companies more often than not prefer to work with a distributor who can take care of all their shipments, logistics, deliveries, etc., etc. So for them, they want someone to manage their entire operation so that they can continue to pamper the customers, the consumers.
Got it. Thank you. And all.
Thank you.
Hello. Thank you. As there are no further due to time constraint, I now hand the conference over to Mr. Raj Shankar for closing comments.
Thank you. Thanks to each and everyone for joining us on the call today. Like I said, for the full year, I'm extremely pleased that the distribution business, both in India and overseas, did exceptionally well. I am extremely happy, more so with the India distribution in terms of the bottom line. I'm also very gratified by the fact that we threw up positive free cash flow both for the quarter as well as for the full year. We were very focused on getting our working capital under check and control, which was accomplished both in India and outside. The one sore point was ProConnect. Thank you for your continued support. Trust us that we know what went wrong. We have put some of the fixes in place. We will correct it. We will consolidate it this year. We will get it back to the growth mode before the end of this year. That's exactly what we are focused on. Once again, thank you for your time and good day to you. And please stay safe.
Thank you. Ladies and gentlemen, on behalf of Redington India Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.